Africa, invest in Africa, but no one's really telling you the practical strategies as a layperson, as the average person. How do I actually, on a practical level, invest in Africa? And a lot of the time we confuse starting a business and investing as the same category. What we are trying to say, and as we go through, is that based on our experience and speaking to people, is we would not recommend that most of us try to start a business here. But what we will say is that it's very practical to actually invest here. And this is all about trying to show you and empower you with the strategies and pathways you need to know and understand to go ahead and invest in Africa. Now, our main goal is to educate you on some of the core things you need to know. But as an organization, what we're trying to do with some of our strategic partners that we're working with, who later on would do an open Q&A, is to actually help facilitate that for you. So it makes it even easier. So, yes. Okay, so these are some of the things we're going to go through today. Why invest in Africa? Where to invest in Africa? We're going to look at some of the growth sectors, because it's important, if we're going to invest, we know which sectors should we actually be focusing on. We're going to highlight the role we diasporans can obviously play in African development. And we're going to go into the heart of what it really means to be a diaspora investor. And we're going to have a good discussion about some of the investment pathways that we can follow, and also how we can all understand our unique profiles as well. Okay. Right. So these are some of the main reasons why we should be investing in Africa. And as it highlights there, all the major economic indicators are signaling that Africa is basically the next major growth region of the world. Asia has had its growth, and the tide is shifting to Africa for a whole load of reasons. One being the fact that Africa's got a really young population that is also growing, so the market is expanding. We're seeing the growth of a middle class in Africa for the first time, which didn't used to exist. From a natural resource standpoint, we've always known that Africa has a lot of resources, but Africa's resources are becoming even more important, especially to do with AI and some of the components that are needed for AI. And then finally, Africa is really the only place left with the most arable land. And at the moment, the only place that can sustain the world's population in terms of feeding is also Africa. So there is a lot of indicators that are basically signaling that it's Africa's time, basically. But what we're going to try and highlight is, whilst all these things are positive, whilst there is going to be wealth generated in Africa, it doesn't necessarily mean it's actually going to benefit the local population, or does it mean that we are the ones who are even going to have a slice of that action? So what we're trying to say is that Africa is not looking for our charity. Africa needs us to invest, and building wealth and contributing to development are not mutually exclusive. And as diasporans, we have a lot of unfair advantages. Our money can really travel here. As I speak about some of the pathways available, what you'll realize is a lot of these things are accessible in the West, but to the average person, you wouldn't have access to some of these pathways. But because of our capacity to leverage, especially with a currency disparity, we're actually in a position where we can actually get access to some of the best opportunities that living in the West will struggle to get. And like I said, this is our home. Like my mother said, this is our home. So to me, investment is about saying that I believe in myself and I believe in Africa. So beyond the building wealth component, this is my home. So even on a very simple level, I think we have a responsibility to Africa, and investing is a twofold aspect. It's not just about building wealth. We're investing in our home. Okay. Okay, so where to invest in Africa? Before we look at some of the major destinations, it's important we understand the investment criteria we have to assess. Because whilst all this development is going to take place in Africa, it doesn't mean that every part of Africa is suitable for investment. And some of the criteria we have to consider is we have to look at the political climate. We have to look at economic factors. We have to look at how developed is the infrastructure. We have to look at the government's policies. And also critically for us as well, we have to look at, are there diaspora organizations there that can actually support and help facilitate our investment needs? And that's a very critical aspect, because the disadvantage we have as diasporans compared to all the other foreign investors is they're a lot more sophisticated, they're a lot more structured, and they're able to facilitate their investments in ways where us on our own can't. So it's really important that when we're thinking about, okay, where should I invest in Africa, that we're actually looking at, is there an infrastructure there to support diasporans? So these are some of the key criteria. And from our assessment, looking at the political, economic, infrastructure, government, and diaspora support, these are really, like, I call it the big five. Ghana, Nigeria, Kenya, South Africa, Botswana. I've only focused on the African countries, not including Egypt, Morocco, and all those kinds of things. But if we're looking at the African-based countries in Africa, anywhere here is a good place to look at. But what we are saying is Ghana, from our assessment, is where, as diasporans, we should be focusing a lot more, because, as I said, if we compare Nigeria, Kenya, South Africa, Botswana, from a socio-political climate standpoint, Ghana is more stable. And in investing, we're always looking at our risk, and we're always looking at how do we mitigate risk. So the fact that Ghana is a lot more politically stable is a big thing. And if you look at, in terms of government policies, if you compare all these major countries, it's very clear that the government in Ghana is actually spearheading a lot of these kind of policies compared to some of these regions. And that's very important because, like I said, we're not sophisticated investors. We're not coming in as syndicates. We're not coming in with a whole team. So from a diasporan perspective, it's important we're actually asking ourselves, is there actually support for me to be able to invest? And so far, the Ghanaian government is leading the way. Also, what has been developing here is we're seeing the emergence of diaspora support networks. Again, this is something that Ghana is a lot more advanced. So organizations like us are sprouting up, but there are different organizations that are focused on different aspects. For example, if you want to relocate here, there are companies, diaspora-led organizations that are driving these things. Obviously, at TG Africa, we focus more on the business and investment aspect. So the fact that you can actually have a support network here is very, very important. And Ghana is the birthplace of really African independence. And Ghana has always been looked at as a shining light. So I think it's very fitting when you look at it from that perspective. Ghana, from an African standpoint, has always been a pioneer in things. And Ghana does have the largest diaspora population outside of Nigeria. Again, so whilst all these other countries are more than suitable investment destinations, specifically from a diasporan perspective, these are the reasons why, from a risk perspective, Ghana is the most suitable. If you were obviously like a private equity firm, all of these things are not as, obviously the political climate aspect will be important for you. But yes, from a diaspora perspective, this is why Ghana we believe, is the most suitable investment destination. Okay, so we know which destinations we should be looking at investing, but now it's about, okay, we also need to focus on the growth sectors, because that's what we're trying to do. We're trying to position ourselves where the wealth is going to be generated and is already being generated. And these are some of the sectors where we're seeing a lot of the growth. So I mean, I'm sure a lot of you guys have heard a lot about agriculture. You've heard a lot about the fact that Africa has 60% of the world's, arable land. We've talked about the rising population. We've talked about opportunities to do with mechanization, value added, and all those kinds of things. And when you look at telecommunications, you're seeing things like mobile money, all those kinds of things. And everyone from the formal to the informal sector has some kind of smartphone. So the telecommunications sector is witnessing a lot of growth. If you just bought stocks in MTN, just as simple as that, your returns will be very attractive. So when I'm talking about telecommunications, I'm talking about things like MTN, Telecel, these kinds of organizations who are really building the infrastructure to support the Africa basically going digital and all these kinds of things. So that's a great sector as well. Obviously, I think everyone has heard about real estate. But yes, real estate is also a really, really important growth sector as well. And some of the driving factors why the sector is growing, again, it's the urbanization, it's the expanding middle class, it's the fact that a lot of diaspora capital is flooding into the market, which is actually raising asset prices. And also, as Ghana is developing, real estate opportunities expand beyond just residential. We're now looking into the commercial space. That is also a growing sector. Tech is also a major area. Africa has about 3 unicorns. And a unicorn is basically a company that is valued over $1 billion. So we're really seeing some exciting things happening in the tech landscape. And it's really driven by a lot of young people. So when we look at tech, we're talking about fintech, we're talking about health tech, agri-tech, all these areas. Even edtech is also a component. And what I really like about Africa's tech boom is that it's about developing African technology-based solutions to address African-related problems. And this is also a very exciting sector. The renewable energy space is also very attractive, just for some of these reasons as well. I mean, I'm sure all of us have experienced power shortage this year. The government is very much big in incentivizing investment into things like solar and other forms of renewable energy. And we actually have an opportunity to leapfrog, legacy infrastructure. Mining is also a very big growth sector that we're seeing. I mean, like I said to you, we've always known that Africa is rich in resources, but the reason why why the mining sector is getting even more attractive is because, like I said, a lot of the things we need for AI and all of that is coming from Africa. So in general, investing in anything related to mining is highly beneficial. And then something that's not often talked about enough is waste management. I'm sure you guys have seen all sorts of stuff lying around. But yes, the waste management sector is also a growing area. Now, I'm not telling you guys to start a business in this. What I'm saying is, when we're looking at building our investment portfolios, you don't want to be straying away from any of these sectors, because this is where the real wealth is happening. Yes. Okay, so for us here at TG Africa, for us, African development is the core of what we can do, of what we're about. And I really think we need to recognize the role we diasporans can play in African development. And like I said, we're not talking about Africa is not asking for charity. We're not asking to donate. We're saying, no, invest in Africa. And investing means you are actually dictating how Africa is going to be shaped. At the moment, the major investors in Africa are non-Africans. And the problem with that is investment is developing. Now, everyone says developing, but developing can take multiple pathways. So if we don't invest in African development, the kind of Africa that will be developed might not be the kind of Africa we're enjoying. Because at the end of the day, whoever invests in Africa dictates its policies. And whether we like to accept it or not, economics is warfare. And we have to pick a side. How we behave with our finances, how we manage our money, whether we like it or not, we are either playing for one team or the other, because economics is a form of warfare. So if we say we care about Africa and we identify with Africa, then we have to understand and look at our behavior, our financial behavior, and ask ourselves, how are we spending our money? Where are we banking? What assets are we purchasing? Because you are either contributing to the problem or you are solving the problem. I've already highlighted the aspect to do with that. I'm a big believer that privilege comes with responsibility. And I really don't think we can shirk our responsibility when it comes to Africa. Whether we like it or not, we represent the 1% of the global African population. I was telling my brother and my mother the other day that you only need to earn $30,000 a year to be part of the global 1%. So we may not think we're privileged, we may not feel like we are wealthy or whatever, but actually speaking, if you earn $30,000 a year, you are in the global 1%. So we are already part of Africa's 1%. Now the question is, how are we behaving? And what we're trying to say is that we need to recognize that privilege, accept that responsibility, because we can build wealth and contribute to development simultaneously as well. And like I've said, Africa is for sale, guys. Africa is for sale. And if we're not the ones buying it, other people are going to buy it. And I really wouldn't like to see the whole of Africa basically turn into a South Africa type scenario, because that is actually what we're seeing, is that it's not just people coming to invest. The same way a lot of us want to come and live here, the whole world's also coming to live here. There's a major exodus happening in the West. I mean, the popular destination is like Dubai and the UAE at the moment, but slowly Africa is coming on people's radars. So non-Africans want to come and live in Africa too, but they are also coming to invest in Africa, and they will want to shape Africa into a way that's suitable to them. And if we're not careful, the whole of Africa will basically be structured like South Africa. That is the severity of the situation as well. Okay, so who is a diaspora investor? So as I put here, a diaspora investor is an individual of African heritage who has primarily spent most of their adult lives in the West and have decided to leverage on their unfair advantages to build wealth and contribute to African development. So yes, for me, the key words there is leveraging on your unfair advantages. Actually recognizing there's a golden opportunity we all have, and how we leverage that not only will be beneficial to us, but it's also about the kind of impact we can make as well. And in general, these are the kind of key motivating factors when you're looking at being a diaspora investor. Is financial freedom important to you? Is legacy important to you? Is impact important to you? And also, even on a very simple level, like, how are we all thinking about our retirement planning? And in the West, that's a major problem. But we have an opportunity to leverage Africa in a way where Africa can be part of your retirement planning. So overall, a diaspora investor is primarily motivated by these kind of core factors. And for all of us, one of them will be stronger than the other. But in general, again, this is how we like to profile what we call diaspora investors. Okay, so I want to talk about why we should not start a business in Ghana. Because like I said, we're not promoting the idea of all of you coming and trying to start a business, because we'll get to it. But what we're saying on a very practical level is that you can invest. But starting a business, you need to have boots on the ground. You can't start a business here, go check on it, call someone, say, oh, how is it doing? It's fine. Here you really have to be here. So if you're not prepared to physically be here, don't try and start a business in Ghana. Also, when you look at a capital requirement, we always say you probably need 3x what you think you need. So if you are starting a business here and your initial assessment is, oh, I need 50,000, you're going to need 3x that. Just given all the challenges. And a lot of diasporans start businesses. Actually, the business itself makes sense, but they don't have the capital to keep it going. That happens a lot. So if you know you're not in a position where you can basically burn cash for a sustained period, don't be trying to start a business here. Ghana is a developing economy. Africa is a developing region of the world. In general, it means that there are high transactional costs. We talked earlier about the legal aspects of things and contract enforcement. And these are one of the challenges is it's very hard to hold people accountable. So the high transaction cost means that if you're trying to start a business here, you have to be prepared to accept that it's not going to go smoothly. Also, one thing that we take for granted is the cultural differences. And I'm not even talking socially. I'm talking in terms of business culture. Unfortunately, Ghana's business culture is very, it's not very mature. It's still in its infancy. People don't really understand business in a formal and a structured way. So us diasporans, we come and we project basic things that you would take for granted. Unfortunately, Ghana's not there yet. So even trying to bridge the gaps in terms of business culture, one quick example is people don't respect time here. You see, yeah. You see, people don't respect time here, but we come from a part of the world where if you start work at 9, you're meant to be there at 8:50. You see, here it's not like that. So that's just a small example of that. When it comes to business culture, we're not synced at all. And Ghana is not developed, it's not at the stage where our business cultures can complement each other. So if you're not prepared to completely reprogram yourself and see things from Ghana's perspective, from a business culture standpoint, you're going to be frustrated. You can be speaking the same words, language to a person, but the translation. So yes. And personally, we hear a lot of stories of people who start a business not going well, all that kind of thing. And we hear a lot of, problems with people who are trying to do business here. And it's my personal opinion that most of the reasons people struggle to do business here is it's actually their entrepreneurial competency. A lot of us are like first-time entrepreneurs. Now, you're a first-time entrepreneur and you're also trying to start a business in a high-risk region. If you fuse these two things together, the risk profile is extraordinary, you see. So if you're not someone who is sort of has a high entrepreneurial competency, or you've had a background in starting and running businesses, and you're coming to Ghana and you come from a 9-to-5 mentality and now you're switching, you're really, really setting yourself up for failure. So that's why this slide only has like 2 points. The only reason you should personally to start a business in Ghana is if you're purpose driven. Like, you have to feel like it's some kind of call in whatever you're trying to do. It's like a calling. If you're just coming because, the business aspect of it sounds good, you are not going to have the level of resilience and persistence needed to sustain all the other things we've just discussed. Because I tell my mother all the time, I want to quit almost every week. You see, that's the level of severity. But if you have that motor driving you, definitely. And obviously, if you're a serial entrepreneur, you're someone who has started run businesses, yes, then come. But if these two things if you don't resonate with any of these two things, I'm not saying you shouldn't start a business, but I'm just trying to highlight that the risk profile is extremely high. That's all I'm trying to say. Okay, so, but if we're not promoting the idea for all of us to start a business, what we're saying is you can become a diaspora investor, and these are some of the reasons why it's very practical for the average diasporan to become a diaspora investor, because you can build wealth without having to start and run a business. It's actually less risky investing than starting a business. On a practical level, we highlighted the boots on the ground aspect. With investing, you don't have to be physically here. You don't have to uproot your entire life. You can take advantage of opportunities here and still live your life as you're living. And also, if you look at starting a business to invest in, let's say you have 50,000. You can use that 50,000 to diversify your portfolio, which means you've spread your risk in 10, 15, whatever, however many assets you choose to invest in. But if you're starting a business, it's just start. So that 50,000 it does not diversify. So if your business fails, everything is failed. But if your 50,000 is spread over 10 or so different investments, different sectors, all those kind of things, then actually your risk is really low compared to starting a business. And again, as an investor, we're making our money work for us. If you're starting a business, you're definitely working in your business, and you're working more than even in your 9 to 5. So an advantage of why it is a lot more practical to be an investor is because done right, your money is working for you. You're not exchanging time for money. Yeah. Next slide. Okay. So now we're going to look at the 5 investment pathways. So we were trying to figure out, okay, on a practical level, how can we all approach investing in Africa? And these are the core 5 pathways we would advise that are very practical, that we can all participate in as diasporan investors. So we have angel investing. We also have acquisitions. We also have real estate. We have the financial markets, and we also have the investors community. So yeah. Now, before I go deeper into some of these pathways, these are some basic things that we should have in the back of our minds when we're now trying to think of ourselves as investors. Risk and return is a very important principle we have to understand. In a nutshell, ultimately, the higher the risk you take, the higher the expected returns. So when I go through the pathways, always have in your back of your mind that different pathways have a different risk profile. So, but in general, just having in your mind that the higher the risk, the higher the return. The lower the risk, the lower the return. The perfect equilibrium you want to find for yourself is, how do I maximize my returns by minimizing my risks as much as possible? So it's that intersection that we all want to sort of try and hit. Another key thing to understand about risk is that risk is very subjective. I know we hear the term risk, but in investing doesn't really mean anything. Risk is relative. So an investment might be risky only if it's compared to something, but on its own, you can't say this investment is risky. It has to be in comparison to something. And it's also subjective because 50,000 to you and 50,000 to somebody else is not the same thing. Someone's willing to just lose 50,000 for the upside that they're seeing. Somebody doesn't want to lose 50,000. So I just want you guys to know, when it comes to risk as well, it's a subjective thing. You have to decide for yourself what your risk tolerance is. But we'll go deeper into these things, and when we look at how we understand our investor profile. A really important thing as well is, in general, we should have in our back of our mind that all these pathways, and investment is all about which stage of the investment cycle you're participating in. You can participate at the early stage of a company all the way to the late stage. And again, if we link investment stages to risk and return, as a general rule, the earlier a company is in its development, the more risky it is. At the later stages of a company's maturity, its risk profile is a lot lower. So in general, that's how you should think of it. if I want to make big returns, I primarily need to be focusing on early stage investments to mid-level companies. If my risk tolerance is very low, then I want to be sticking to later stage companies because they're a lot more mature. They have stable cash flows, all those kinds of things. So these two things are very essential, but you should just have in the back of your mind that ultimately we are going from early stage all the way to late stage. And anywhere in between that also correlates to risk and return. Also, you have to ask yourself, do I want to be a passive investor or an active investor? And all this simply means is, do you want to be really involved in the investment, as in actually sort of contributing some kind of time and effort? Or do you want to build a passive portfolio where, for the most part, your interaction is very limited? So as an investor, and again, these are sliding scales, but you have to decide for yourself, do I want to be more on the passive side or do I want to be more on the active side? And it's a sliding scale. So that's something that you need to also have in the back of your mind. Again, the more actively you're involved, potentially it influences the returns. The more passively you're involved, the same thing. But that's a really important concept to understand. And portfolio management is also a very important concept to understand. Ultimately, that's what we're trying to do. We're building a portfolio. And the idea is, how do you structure a portfolio based on different assets that also align with whatever your wealth building goals are? So ultimately, wealth creation is about building a portfolio for yourself. And yeah, we haven't come across any get-rich-quick schemes at all. So what we are saying is that building wealth is a process, and it's about us deciding to partake in that process. But there are no get-rich-quick schemes. It's very much a process, and when it comes to investing, time is a very big criteria. The longer your time horizon, the greater your returns. The shorter your time horizon, the opposite. So that's another important thing to also consider. Is anyone familiar with the concept of angel investing at all? Yeah. So as I put here, angel investing is when individuals fund early stage startups with their own money in exchange for equity, offering crucial seed capital, sometimes mentorship, industry expertise, basically to help a new business grow. And what you're really trying to do is to bet on the future potential of large returns when the company is either sold or it goes public, or you're simply benefiting from its future dividends. Again, we're dealing with super new companies, very early stage. So as an angel investor, yes, you're taking high risks. And ultimately, as an angel investor, what you're trying to do is get in early on the action, because you basically know that if this thing really pops off, I'm 10x in my investment. But we'll break down the structure of an angel investing and whether it's suitable to us or not. So, yes. So realistically speaking, if you're attracted to angel investing, you don't want to be going further than seed round. So seed round just means the business is still just in an idea stage. So like nothing's happened. You're going to give the business or the entrepreneur the capital to actually get going. At Series A level, now the business is in motion, but it's still in product development. So they're still trying to refine and also find their product market fit. And then Series B is the company has proven its business model already. So the company has already shown proof of concept. So obviously, again, going back to what I said about risk return and stages of development, super high risky, but super high returns. At the Series A level, the company is a little bit more developed, but it's still product developing. It's still trying to refine itself. Again, not as risky, but still pretty risky. but offers super high returns. And at the Series B level, you're just trying to finance its growth so that the company is working. You're just turbocharging it with your capital. That's the idea of angel investing. So again, going back to risk tolerance and what your risk tolerance is, if you want to be an angel investor, what I'm saying is that these are the 3 stages of a company's development. So you can decide, you know what, I want to minimize my risks. I actually just want to invest in companies that are already showing they're successful. I just want to help finance their growth, and I'm comfortable with that. So you can base your whole investment strategy on purely just doing that. Or you can have a mixture. All these things will be important when we actually break down your investor profile. But for now, I just want to explain the pathways and how they're all structured. So, okay, so we've talked a lot about the fact that with angel investing, ultimately, it is a higher risk, high return investment pathway. But at the low end, you can 5x your returns. You see, that is why it's so attractive. That's on the low end, and you can go up to 10x in your returns. That's really the attractive thing about angel investing. That's why people do it. Yeah. So next slide.
You should not tell everybody, hey, you put just explain a bit more.
Yeah, like a multiple of 5. So if you invested 1,000 in an early stage venture, it could be, in terms of returns, you're looking at it being worth 5,000, 10,000. But in general, with early stage ventures, the multiple of 5 is like the standard. You shouldn't be investing in a company if its profile doesn't look like it has the capacity to 5x your return because of the level of risk you're taking. You see, so that's the crucial aspect. Sorry, go back to that page. Yeah, this aspect is very important. A good strategy with angel investing is you want to spread your investments as wide as possible. You see, so you want to put your money into multiple early stage ventures because in general, most portfolios, especially in the venture capital world, for example, it's known that 90% of their investments are going to fail. That's like priced into the structure. And they make their money from the 10% of businesses that are actually successful within their portfolio. So a VC, for example, that's what they do. They mainly like to focus on early stage investments and they diversify and build a strong portfolio. But they know that 90% of these businesses are not going to be successful. But you only really need 10% of them. So the main thing I'm saying is that as an angel investor, diversifying is important. You don't want to be putting all your eggs in one early stage investment. You want to have a multitude of them. But if a small fraction of them are successful, it would actually return your capital and then some. So that's really an important factor to know. Yeah. So what kind of profile of a person suits angel investing? If you have a high risk tolerance, if you're actually passionate about the startup, sometimes you don't even have to invest money into the business. You can actually be given equity in a business in exchange for your advisory support, because you might come from an industry where by you investing in this company, just by being associated with the company, you can make the right networks, connections for them. So sometimes it's not even a money thing as an angel investor. They just may strategically, you as a person could be valuable to the actual growth and development of the business. So you can negotiate equity in exchange for what you're going to do to support the business growing. So sometimes it's not just actually giving them money. So it does help if you have some sort of industry expertise or connection within that particular sector that business is in. Also, a lot of the time, it's whether you're really passionate about the company as well. Like you genuinely believe in what they're doing and you want to see them succeed. So that's another motivating factor to be an angel investor. It also helps if you have an entrepreneurial background, because if you've started a company before and you started and run a company and got it to a certain level of development, your expertise becomes very valuable to an early stage venture as well. And again, going back to the concept of passive and active, you can choose to be as actively involved in the business or as passively involved in the business as possible. So when it comes to that aspect of things, again, it depends on what's motivating you here. Because if you're actively invested, then it means that you're actually going to be involved in trying to help the business succeed. If you're passively investing, you're just saying, I like this entrepreneur, I like the idea, I believe it's going to be the next big whatever, so I just want to hedge my bets on that. See, so how passively or actively involved is really dependent on you. Yeah. Okay, so this is where it gets exciting, because going back to how I explained what being a diaspora investor is that we have the opportunity to leverage on our unfair advantages. In the West, angel investing, you would need minimum 50K, 50 to 100K. That's the profile of an angel investor. Whereas in Ghana, you can be an angel investor within a ratio of 10 to 50K. So think of Facebook, think of all these types of companies. If you're in the West, you will not have access to these companies. But Africa and Ghana has its growing companies. It has its innovative companies that with simple investment of 10K, you can actually get a stake in it. And this is what I mean, is that we have the unfair advantages here to be angel investors in a way that if we were in the West, we would have to have minimum capital requirements of 100K or so. And in general, these are the challenges that come with being an angel investor. It does take a lot of time. You definitely need to do some due diligence. It requires a lot of effort, obviously oversight. Your competency can either make the investment more successful or not. And liquidity is an issue. It's with an early stage business, it's hard to get your money out because first of all, it's super early. And it's very hard for someone to either buy it or for you to sell it. So when you invest in an early stage business, you have to have a 10-year mindset, realistically. But a lot of these areas is basically what we want to help facilitate for people. Our job is to try and make investing on the continent as easy as possible. So the idea is we put the structure in place to address the fact that we know a lot of people wouldn't have the right competency. It's difficult for people to have the oversight over their investments. A lot of people are working, and a lot of time and effort required is also an issue. And you can't invest in Africa without a very strict due diligence process. And again, this is a barrier that potentially deters people from wanting to invest. But at TG Africa, our job is to remove all these aspects. But it's important that you're aware of the challenges that come as an angel investor. Okay, so we know about angel investing, we understand the risk return, we understand some of the challenges, but where do you go to find these opportunities? So we spend a lot of time actually doing some due diligence and looking at local organizations to assess which ones can we signpost diasporans to, which ones do we want to work with that they are providing the right type of at least basic structure in place for us. So we have Ghana Startup Association. They have a great portfolio of really young companies. You can easily get in contact with them. And yes, like I said, they've got a great portfolio. InnoHubs too. Okay, so I'll highlight something. So a lot of these companies are what we call accelerators and innovators. And it's really important that when you're looking for opportunities, you focus on incubator and accelerator organizations, because they're basically like a school for startups. They're receiving guidance, support, capacity building. It's not just the entrepreneur on their own. And that significantly reduces your risk profile because you're not going outside of that framework. A lot of the opportunities you're presented to, like, it's actually a real business. It's actually structured somewhat decently, and they are receiving some kind of guidance. So already it's significantly reduced your risk profile from just going on the internet or whatever and finding something. It's a level of filtration that's already been done for you. And these are some of the great organizations that you can look into. I mean, is anyone familiar with the concept of digital farming? So digital farming is literally where there's already a team in place locally, and you can just simply decide how much you want to invest, and they will run your agribusiness for you. It's literally that simple. And I really like it as a concept because it's twofold. It helps smallhold farmers grow and develop, but at the same time, it's like the best way and the most easiest way to get into the agri sector. We're in the agri sector ourselves, and my mother can tell you the challenges of you being the person actually running it. So imagine there's already an infrastructure set in place, and all you're doing is deciding how much capital you want to invest. But there's a whole agri team that is actually doing it for you. So digital farming is still a relatively new concept, and going back to the fact that I said the agri sector is one of the major growth sectors. So it gives us a very practical way of having some kind of position in a sector without, again, all of the challenges of actually running an agribusiness. So I thought it was something good to highlight. And we're actually going to have a representative from the University of Ghana's Innovation and Incubation Center come to tell you a bit more about what they do, the portfolio companies they have, and you can ask them some questions as well. That'll be in the final segment. But yes, so main thing I'm saying is, if you want to be an angel investor, focus on accelerator and innovator and incubator organizations who are already developing these early stage startups. And these are some of the reputable organizations that I'll recommend.
So can you tell?
Yes, what would you?
Is it kind of like buying shares in a already established agricultural business, or it's like?
No, you're not buying it. It's literally you've outsourced the labor of actually running a farm. So this company has structured itself in a way where they're trying to solve the problem of how do they get investment into agri sector from diasporans, knowing that it's very challenging for the average diasporan to get into the agri space. So the idea is they've structured themselves in a way where if you want to invest in the agri sector, if you want to do fish farming or whatever, they have the team in place to actually be running it for you. If that makes yes, 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 exactly, yes. In a simple terms, yes. So that's the digital component, is that you're technically farming, but you're not actually farming. A few years. But across Africa, it's something that is really emerging because, like I said, it's very difficult to get into the space, and also we don't really need diasporans going into the space. We just need capital injected there. So this kind of solves two problems where you can empower smallhold farmers and at the same time get into the agri sector as well. Yeah. Okay, so the next investment pathway is acquisitions. Are you guys is anyone familiar with what acquisitions are, or acquisition entrepreneurship? Have any of you guys come across that concept? Yeah. Okay, so acquisition entrepreneurship is the strategy of buying an existing profitable business instead of starting a new one from scratch. And then you're basically, sometimes you're using your entrepreneurial skills to grow and scale it, but not necessarily. But the main thing is you're buying an existing business that is already profitable and well established. And this approach offers a very low risk, immediate cash flow approach because these companies, they're mature. Ultimately, especially in Africa, there's a lot of entrepreneurs who've built really successful businesses, but they don't have it. They can't trust their families to carry it on. And it's like the guy is still running it, but he doesn't want to. So there's a lot of motivated sellers that want to just sell their businesses. But here it's not like the West where the infrastructure for buying and selling businesses is developed. So there is a big opportunity. Again, you don't have to start the business. You can just buy the business asset. The business is already generating profit. So you're basically living off the income. Let's Yeah, so ideally, acquisitions are always good in boring industries. What I mean by a boring industry is our modern economy has certain core staples in terms of it doesn't matter if we're in an economic boom or a bust, these industries are necessary. Like waste management is a boring sector. It's not, a lot of the time we think investing is about the next up and coming tech this, that, AI this, but actually, from a pragmatic standpoint, a boring business is stable. Its cash flows are stable. Its demand is stable. It's not affected by macroeconomic factors because we all need those types of services and they're mature like that. So that is what you want to be targeting when I'm talking about acquisitions. I'm not talking about, this is not angel investing where you're looking for the next big thing. With this, you want to find a business asset that you can just buy that is already working. Again, usually you're looking at a business that is at least sort of 10 years old. So it's seasoned. You see, the business is seasoned. Again, it has stable and predictable cash flows, which is important. Yeah, so when we look at in terms of the risks, return, this is one of those opportunities that is low risk to medium. Sometimes, but at the same time, it also offers medium to high returns. So again, the positive thing about if you go down the acquisitions pathway is your risk is quite low. You can make attractive returns, but you're not going to be making supersized returns because if we go back to the investment stages, you're buying assets that are in the later stage of the business cycle. Yeah. Yeah. So this really will suit somebody who has got a low risk tolerance. With this, again, you can be as passive or as actively involved as possible. Because bear in mind, this is a business asset. So it means it already has a management structure in place. You're not coming there to change anything. All that is happening in the business is a change of ownership. So you've given the owner an opportunity to liquidate whilst you benefit from future cash flows. That's basically what you've done. But ideally, these companies, they already have a management structure in place. Now, the active component comes in where, again, if you have the competency and you can make improvements to the business, you can actually boost its cash flow. So sometimes what some people do is they will buy a business and they will make basic improvements to make it more efficient, reduce operational costs, add some tech into it, add some automation into it. And those simple things you can calculate and go, oh, I can boost annual profits by 10% if I just do these basic things. But you can generally just, the same way you can buy a house and then rent it and you collect your rental income and all that kind of thing, you can be as passive as that with an acquisitions approach. Obviously, you will still have to have an oversight component, but it's really just you're just checking up, really. Like I said, in terms of investment competency, it does require some level of investment competency because you have to assess the value of the business because you're going to buy it. And again, if your strategy is to not just buy and you want to buy and improve, you obviously have to have some kind of business acumen to know what you want to do to make it better. But generally, you don't really necessarily need to have an investment competency. Again, like I said, we want to facilitate these types of things for people. So if we figure out that your investor profile suits that your portfolio should have more of these things, then again, we have the structures in place to do the due diligence, the valuations, and all those kinds of things. But next slide. Now, this is an interesting thing about acquisitions as well. Okay, so I'll highlight the first one. Yes, so if you want to buy a relatively good business here in Ghana, you need to be looking 50K plus as sort of a basic level. Now, this is if you want to buy it with your own money. But when it comes to acquisitions, there's something called seller financing. Is anyone familiar with that concept? Oh, I meant in like dollars. Yeah. Well, is anyone familiar with seller financing as a concept? You are. Okay, great. Yeah, so seller financing is where you actually structure a deal with the owner and you basically buy the business off them and you pay it in monthly installments. So you don't actually have to have them. So let's say the business costs 100K. Depending on how motivated the owner is to just get out of the business, you can structure a deal with them where kind of like a mortgage, you're just paying off ownership, but you're using the cash flow of the business to pay it off. So in terms of a risk, you're not actually taking any risk on. That is the beauty of seller financing. So imagine just building a portfolio like that where you own a whole range of business assets and you never actually use your money to buy it. And you're using the cash flow of the business to pay off your monthly payments. And seller financing is similar to that small business acquisition loans. Again, kind of like how you can take out a mortgage to buy a house, you can definitely take out a loan to buy a business and use the cash flow of the business to pay off the loan. And your profit is the difference between the cost of borrowing and then the profits that are being generated. So I really like acquisitions because, like I said, it offers a very high return, low risk approach, especially given that you don't even have to have the money to tap into this opportunity. Again, these will be a consistent theme. It does require some time and effort because you have to source out the opportunities. You definitely have to do your due diligence. Obviously, oversight is a thing as well, and liquidity can also be an issue too. But again, like I said, we want you to understand the challenges, but our job is to take up that responsibility for you. Because if we can make investing in Africa as easy as possible, then we can get more people investing. That's the whole idea. Okay, so I'm pretty sure we all know what real estate is and investing in real estate. But ultimately, yes, what you're doing is you're buying properties, either residential, commercial, or land to generate income. And you're doing it either through rent or profit from the appreciation of the asset or a combination of the two. I mean, real estate is really attractive because it's a great way to diversify your portfolio. It's just a good way to preserve your capital, just in general. And it's a good hedge on inflation. Yes, next slide. Yeah, so when it comes to different options, when it comes to real estate investing here, you can buy and rent, build and sell, buy and rent, build and rent to rent. You can either do a rent to own structure. You can basically just focus on land banking where you're just building up a huge land portfolio. I mean, land is such a valuable asset here that if all you ever did was just spend the next 10 years just buying up land and that was all you did, 10 years after that, your returns would be extremely attractive. So even on a simple level, but is anyone familiar with this real estate investment trust? Okay, so a real estate investment trust is basically like it's a mutual fund where different people have put money into it, and the investment organization basically does all of these things, and you're just basically getting paid from the income that's generated. So again, you don't have to do all of that because the company is basically going to facilitate that for you, and you're just collecting your passive income. So it's a really, and these real estate investment trusts, they already have the properties, they already have the tenants, all of that kind of thing. So they're just basically managing the properties, collecting the money, all that kind of thing, and paying it to their investors. So if you own 20% of a particular investment trust, then you're getting 20% of their rental income every year. So it's a really simple way of investing in the real estate sector without all the hassle. essentially. Yeah, so in general, real estate investing is very much a low risk investment pathway. That's why it also realistically only offers low to medium returns. So it's a very safe investment pathway, but its returns are not as attractive as some of the other ones we've looked at. But yeah, you are looking at 9 to 15% sort of an annual yield, which is, higher than even in the West. That's why real estate is so attractive here. But actually in short-term rentals, it's 22% and upwards. So, I mean, I'm saying it's low to medium returns, but if you remember what I said at the start, when we think about risk and return in investing, it's always in relation to something else. But yes, in general, 20% is a pretty good return, annual return. Yeah, if you want to buy a decent house here in Ghana, you're looking around that kind of 100,000 mark. But there are mortgage facilities available. So just kind of like how mortgages work, you can't buy houses here now in Ghana because different banks offer diaspora mortgages as well. So it's kind of like the acquisition strategy. Again, you can build a property portfolio based on leveraging mortgage instruments and all that kind of thing. At the moment, we can't say what bank to go and take our mortgage with. We're still doing a due diligence on that. But yes, the main thing to know is that mortgage facilities are very much available to diasporans as well. Yeah, so I already highlighted, if you want to look at your profile, it's very much a low risk. It's very good for someone who has a very low risk tolerance. It's very good for someone who is firstly wanting to just preserve their capital. Or if you're thinking about retirement, it's a very passive form of investing. And you don't really need to have that high of an investment competency to adopt this pathway. So these are the two local organizations that we form relationships with, which they should be coming later on today for an open Q&A where you can ask them whatever questions you have. But this organization is really good, Cura Africa, because they've built a data analytics structure so that you can evaluate which areas make sense to be buying houses and all that kind of. Because unfortunately in Ghana, one of the high transaction costs of what I was speaking is that access to information is very difficult. So he's created a platform where it basically does your due diligence for you and it does your market research for you. So it's the starting point of knowing where to seek out opportunities, because in real estate, really the number one priority is like the location. That really dictates whether it's going to make you returns or not. So yeah, he will come here to talk to you guys a little bit more about that. And Majestic Homes are a one-stop shop. So go back to the slides. Yeah, go back. Yeah, so they can basically help you with all these approaches, because they're a one-stop shop. Again, the reason we work with them, because again, how do we make investing super easy? So whatever strategy you decide to adopt, they can basically facilitate that for you. Next, let's go back. Yeah. Yes, again, we've highlighted the challenges. Yeah. Okay. Now, the next pathway, which I want to discuss, is the financial markets. And essentially, when you're investing in financial markets, you're putting money into assets like stocks, bonds, currencies, and you're doing it on a stock exchange where buyers and sellers are trading. And the aim is you're trying to grow your wealth over time by earning returns, either from income through dividends or asset price appreciation. And at the same time, you're actually so helping businesses and governments raise much needed capital. Next slide. So when it comes to investing in the financial markets, these are all the options you can do. You can invest in stocks, you can buy government bonds, and in Africa, government bonds offer really high interest compared to the West. You know, on average across all markets, you're looking at 15 to 20% interest that you're getting every year from government bonds, because African governments are looked at as more riskier than Western governments. So they have to offer higher attractive interest so that they can raise money to finance whatever it is they're doing. A lot of people don't realize this, but yes, even when you want to look at Africa's stock market is performing way better than Western markets. Again, Africa is a growing economy, so all the companies that are in its public markets they represent the best of African companies. And if you look at a risk-adjusted return with stocks, just buying stocks, you're looking at 9%. In the West, you're getting like 3%. Now, is everyone familiar with what mutual funds are? I kind of highlighted it with the REITs, but do you know what a mutual fund is? Yeah. So a mutual fund is simply a company that just basically pulls. So let's imagine all of us here, and this is the investment organization. And basically, there'll be like a minimum capital requirement. So it could be something like 50K. But every mutual fund will have its specific investment strategy. So one mutual fund might specialize purely in tech-based companies. So they only buy tech-based businesses like stocks, because mutual funds mainly trade and buy stocks. So they might that's their investment strategy. Another one might be telecommunications. And in Africa, there's lots of different mutual funds you can buy. The most important thing about them is that if you agree with their investment thesis, they're doing the investment for you. You pay them the fees, annual fees is usually like 2%. And again, it's a great passive strategy. And like I said, going back to when I was talking about the growth sectors, you can genuinely decide, okay, my investment strategy is I'm just going to put my money in mutual funds that specialize in all these different growth sectors. So I want to put my money into a mutual fund that specializes in telecommunications, one that specializes in all those types of sectors. There are a range of mutual funds available. The most important thing to know about them is, like I said, as long as you agree with their investment thesis, like how they make their investment decisions, then fundamentally they're doing the investment for you. Is anyone familiar with ETFs, exchange traded funds? So an ETF is just a mutual fund that is traded on the stock market. So the same way you can buy shares in stocks, there are mutual funds who are set up like companies. So you can actually buy shares in them, and you can trade them. So that's all it is. The reason why these came about was because for the average investor, mutual funds tend to have quite high capital requirements. Like I said, the buy-in might be like 50, 100K, 1 million sometimes. So most people don't have that kind of money. But an ETF, that mutual fund, if it has been converted into a company with a tradable, which is trading on the public markets, its share price might be $100 today, whatever. So you can buy as much of it as you want because you're not bound to the capital requirement. But that's all it is. It's basically a mutual fund that you can buy shares into and sell the shares from. And again, the main difference as well is that this is a cheaper alternative to if you don't have the capital requirements to invest in a mutual fund. I've already highlighted REITs, real estate investment trusts. They are very similar to ETFs in the sense that they are also tradable. The reason why these things, in general, the really big advantage of investing in the financial markets is that it's a very passive strategy, but it has a high liquidity compared to all of them. which simply means that you can get out of your position. So let's say your investment thesis, what you bought shares, bonds, whatever in different assets because you believe that the future looks good for these companies. But let's say things change in the world and you assess and you realize, you know what, I don't think my original thesis is carrying on. You can get out of that position very quickly. But with all the other options, you can't just exit your position. But with in the financial markets, you can come in and out of your positions really quickly, which is highly attractive because it allows you to basically rethink and restructure your investment approach. Yeah. Yeah. So like I've highlighted, this is something that in general we should all allocate some portion of our capital to this. It would not make any sense not to. It's very low risk, low to medium returns, risk adjusted returns, you're looking at 8 to 9%, which is, like I said, if you want to compare the West to Africa, Africa is way more attractive from a return standpoint. Also, the other thing to know about the financial markets is volatility is an issue in a sense that in the short term, maybe today, if you looked at your share price, it's gone down drastically or it's gone up drastically. In the short term, stocks behave very erratically, but in the long term, they do follow general economic principles. So when you're investing in the financial markets, you're not meant to be watching your portfolio every 2 seconds. Because if you do that, you start panicking and thinking, oh my God, my shares have gone down. It's in the long term, financial markets do follow the real economy. So they're stable like that. That's just something to bear in mind. Now, this is the great thing about investing in the financial markets. You can literally, I was trying to think of the lowest figure I could think that was realistic, but you can literally enter in African financial markets with as little as $1,000. And how high you go is how high you go, you see. So it's also very accessible to all of us. That's another attractive aspect about the African financial markets. Again, this is definitely a really passive strategy that most of us can adopt. But you can actually also adopt an active investing strategy if you want to specifically pick your own stocks and evaluate them and all those kinds of things. But like I said, there's already pre-packaged investment products that you can just buy. You don't need to try and work out what you think is going to be, all that kind of thing. So if your competency is high and you know how to evaluate stocks and shares, you can definitely refine your selection process. But for 90% of us, it's a great passive strategy. And it's really good if your priorities are things like retirement. Again, if you just want to preserve your wealth, and also if you want to achieve financial freedom, it's a very great way to achieve these things. I'm not finished. Again, it opens it up to anyone from having a low investment competency to a high investment competency in terms of how to evaluate what types of businesses to invest in, all those kinds of things. Yeah. Realistically speaking, these are really the main challenges. Again, you can make more returns if you have a high investment competency because you know how to evaluate the companies, you know how to assess their share prices and all those kinds of things. So you don't actually need to put your money in a mutual fund or all these kinds of things if you have a high competency. And in Africa, historically, there's been issues to do with accessibility to markets, but all of that is changing, and the guys from Blackstar will come and do a Q&A, and they are our main partners when it comes to helping facilitate access to African financial markets. So historically, accessibility has been an issue, but that's changed. So nowadays, you can actually buy bond shares, all those kind of things, anywhere in the world, and all that kind of thing. Yeah. So where to go again? Lackstar Brokerage and Advisors, and they'll be coming later today to talk to you a bit more about the suite of products they have and answer any questions you want to know. Yeah. Okay, so the final pathway is a pathway that we created for ourselves. We want to address the issue of how do we make it easier for diasporans to actually invest on the continent. And historically, there's been a lot of barriers that have made that difficult. But we believe that with a combination of leveraging technology, having the right local partnerships, and having diaspora boots on the ground organizations, we believe these three factors actually means that we can actually easily invest in Africa. But ultimately, what the investors community is a diaspora-led private investment community founded on principles of collective economic cooperation, self-organization and governance, and the idea of building wealth through development. So what we mean by collective economic cooperation is we have realized that whilst there's a lot of opportunities in Africa to build wealth, some of the greatest opportunities, like we're talking mining, telecommunications, all these kinds of, they're capital intensive. So most of us would not have the kind of capital to tap into those opportunities. But collectively, if we pooled our financial capital, we'll be able to tap into those opportunities. Just like any big investment firm or any foreign investors doing. What we're trying to do with the investors community is start thinking more of a syndicate mindset. Because a lot of us are coming here and are investing individually, but there's only so far you can go with that. But collectively, our remittances alone to Africa is far superseding foreign aid, you see. So collectively as a group, we have a lot of power economically, but individually we don't. So one of the core principles is about bringing our money together to tap into some of the best opportunities that are available. Self-organizing and governance is another key principle for two main reasons. Unfortunately, as we've said, Ghana, Africa is still a developing economy, which means that its business culture isn't as mature as it should be. And unfortunately, local organizations, what they may look like and what they actually do are two different things. And unfortunately, the environment is too risky for us to just think we can just sort of directly give our money to an organization to invest it for us. We've realized that we actually have to play that role for ourselves because, again, what our business culture is and what the local understanding of business culture is not the same. So whilst we can partner with local organizations, it's not advisable that we go direct. We need our own diaspora-led organization that can actually be the bridge that connects the everyday diasporan to the right local organization, all those kind of things. And the second part of why self-organizing and governance is important, it's because it's about a trust element and it's about transparency. One of the biggest problems that makes it difficult for us to come together to pool our capital is because we don't really trust each other. And historically, we've not done very well as a community when it comes to collaboration. And we can go into all the reasons for that. So how the investors community is structured is that at the senior levels, the organizational structure at the board level, it would actually be made up of members. So there isn't really a separation between the organization and the members of the community, because members of the community will actually be playing a role in the organization, dictating things. So it means that we're all watching each other, we're protecting each other because we're all directly involved in some way, shape, or capacity. It's not a third party that you've sort of outsourced your investing to. That's the self-governance, self-organizing aspect is. And then finally, the community fund will pursue a development-led investment thesis, which basically means that we are only going to be investing in businesses that are playing some kind of role to support development. So we're going to be very much heavily focused on the agri sector and all the major growth sectors because we're following a development-led investment thesis. So whilst we have a profit-based motive, we will also be evaluating companies based on a development criteria. And we will specifically focus on companies that need growth financing. So in terms of the actual investment pathway that this particular the investors community will follow is we're going to be trying to finance the growth of already successful businesses that need a capital to basically scale. So these are the three core principles of the investors community. Yeah, so if we look at the risk to return ratio of the investors community, it's definitely a medium to high risk opportunity. It's medium to high risk because we're financing companies at the Series B level. So these are companies that probably existed for 5 to 7 years or so. They have shown a proof of concept. Their revenues are growing or their profits are growing, but they have bottlenecks that are restricting their capacity to scale. So the idea is that with a capital injection, we can help these companies actually scale their operations. That is the key thing to know. And we're ultimately trying to tackle the SME financing problem because at the moment, just in Ghana alone, there's a 50 billion financing gap. So we actually have a great opportunity to use diaspora capital to solve the financing gap, which will only lead to building wealth and also contributing to development at the same time. But it definitely does also bring high returns because, again, compared to financial markets, you're investing in really mature businesses. Compared to acquisitions, late stage investments, we're somewhere in the middle because they're not early stage ventures, but they're also not late stage. They're in like that middle. I like to say, think of a teenager. A teenager is going to mature into an adult, but they haven't yet made that leap. And we're going to basically help them go from a teenager to an adult. And that is why we can reap these types of returns. At a minimum level, you're looking at a 3x to a 5x. The returns are just as attractive as, like I said, angel investing and all those kinds of things. Yes. Yeah, so we wanted to make the investors community as accessible to everyone as possible. So really, to become a member of the community, you just need to be in a position to be making a minimum monthly contribution of 500 Ghana cedis a month. But you can decide how high or low beyond that you decide to go. Again, when we look at how you understand your unique investor profile, you would know how you can leverage the investors community as a pathway for yourself. But yes, it's definitely very accessible. We wanted to make it accessible as possible. So that is basically the capital requirement you need to participate in a community fund.
Yeah.
In general, again, we are in Africa, we are in a developing economy, so there are challenges. Due diligence is going to be a big thing. That is why we've invested in partnering with the right local organizations, these incubators, these accelerators, because they're already part of the filtration process. But definitely, yes, really making sure we are doing the right due diligence is going to be very critical. Also, there isn't actually an investment blueprint to follow, even in the SME sector as a whole, because Africa's financial system is not structured to support SME sector at all. So we're really pioneers in the sense that there is no blueprint to follow. We have to learn as we go. But that is the risk-return ratio, is that because we're pioneering into it, that is why we can get returns up to 5x, 10x. A lot of these companies, we're going to have to provide them more than just capital. I know we're talking about the legalities and all aspects. So a lot of our job will be on actually structuring these companies properly so that they actually become mature. So beyond money, we will have to help them with their financial management, their operational structures, their HR, all that kind of thing. the great thing is we can leverage members of the community for it as well. So I just wanted to let you know that they need more than just money. They also need holistic support. Also, as an investment pathway, it only works at scale. So we're on a big push to reach 150 members, because if we're at that stage and every year we have 100 to 150K worth of investment capital to make, we're in a very strong position. And like I said, the purpose is to tap into capital intensive opportunities that on an everyday level we wouldn't be able to have access to. So it really only works if it's done at scale, as in the membership is big, because that is the only way we can tap into some of the big opportunities that the Chinese do, the Lebanese do, all that kind of thing. So that's how I want you to think about the investors community. It is our form of a consortium that is facilitating the same role that a Chinese consortium would do, a Lebanese consortium would do, an Arab consortium to do. Yeah. And yeah, where to go for it, teacher. So yes, hopefully we've looked at why we should invest in Africa. We've looked at which destinations we should invest, but specifically why on the whole, based on the type of criteria as diaspora investors, we have to consider why Ghana is probably the most suitable for us at the moment. We've also looked at the various things we need to consider about generally when it comes to investing, understanding the relationship between risks and return. Also understanding that when we're looking at investing, it's all about what stage in the life cycle of the business that we want to invest in. And again, there's generally a good correlation between high returns at early stages, but it also comes with higher risks. And we've looked at how later stages, lower risk, but also the returns are lower. We've talked about angel investing. We've talked about acquisition strategies. We've also looked at real estate investing. We've also looked at the financial markets. And we've also looked at the investors community. Now that we have that foundation built, it's about each of us turning the attention to ourselves and asking ourselves, what is my unique investor profile? Because if we can all really understand what our unique investor profile is, then we know how to leverage all these different pathways. What I will say as well is, in this session, we're simply just going to look at them, but everyone who's come, we will be booking organizing a one-to-one consultation to actually help you evaluate it for yourself as well. But it's just important that today we have a good foundational understanding of all the factors we have to consider to work out what our unique profile is. Okay, so we'll be looking at, so these are really the core factors that will affect what our profile is. We'll look at motivations. We'll look at risk tolerance. We'll look at investment capital. We'll look at the life stage you're in and how that influences how you invest. We'll look at what kind of demographic you belong to and also how that influences your investment strategies. We'll look at timeline as well and how your investment knowledge and competency also influences what type of profile you have. Okay, so generally speaking, what we all need to ask ourselves is, these are really the core motivations. So financial freedom. And I like to think of financial freedom as, what is the minimum amount I need to be earning passively from my investment portfolio that can allow me to maintain what quality of life I want without me directly actually working. So for some of us, that's going to be a very important motivating factor. A lot of us are also might be primarily thinking about retirement and how we structure our retirement. That's also a big motivator for a lot of us. We're also looking at, some of us have children, all those kind of things. So it's about, actually, my main motivation isn't necessarily financial freedom, retirement. I'm actually thinking about building a legacy for my children. I'm thinking about generational wealth. And then impact. For some of us, maybe our priority is none of these things, but it's just the kind of impact we want to make. So we're investing because of the impact we want to make. In general, whilst you can try and combine all these, you have to really narrow down on what's your core focus. You can't really mix it. So when we do the one-to-ones with everyone, we will try and really hone down what should be your core focus. But in general, these just off the rip, which motivations do we think sort of we resonate the most with? Just out of curiosity. You?
Or is it impact,
Impact.
generational wealth, and financial freedom? Those clear
Okay.
reason why.
Oh. Anyone else want to share which one out of all four you say is like the main one that impact?
I said financial freedom. Then
Michael?
you this week.
Should be. Yeah. Cool. Okay, let's move on. Yeah, so we've looked at what our motivating factors is. Now we've talked a lot about risk. So we now need to evaluate what is my personal risk tolerance. As we discussed earlier, risk is a subjective concept. What riskiness means to you is not the same as what riskiness means to somebody else. But ultimately, this is what you need to ask yourself. How much capital am I willing to invest that in a worst case scenario of the investment going bad, I will be comfortable with the loss and it will not significantly impact me financially? Ultimately, when you're investing, you should be investing what you're willing to lose as your downside, because when you do that, you've limited your downside, but you've made your upside unlimited. So that's how we should understand what our risk tolerance is that ultimately I need to have a range in terms of capital that I feel comfortable risking and losing, but so that I protect my downside, but I've let myself exposed to the upside. So this is a question that you need to ask yourselves. The next thing is investment capital. How much money do I have to invest? And also, how much money do I need to invest to achieve my wealth building goals and objectives? So really with this, you have to balance the two. It could be a situation where your primary motivation as a diaspora investor, currently may not actually align with the current capital you have. So we have to try and strike a balance between these things. But these are the two questions you have to ask yourself. How much money do I have to invest? But how much money do I actually need to achieve my wealth building goals and objectives? And it's about developing that strategy and being able to answer that question for yourself. It's really important. Okay, so we also have to look at our life stage, like where are we in our lives? I just try to highlight, the 3 key areas you can potentially be in. Some of us are young here and just entering the workforce. So, in general, when you're younger, you can take more risks because if things go bad, you still have time to rebuild yourself and everything like that. So in general, we say if you're in your early stages of life, this is the best time to be focusing more on high risk investment opportunities because the upside is also really high. But once you start entering the married with a family life stage type setup, again, it affects the kind of risks you want to take. So obviously, if you have a family, you want to make sure that you're focusing on the kind of pathways that are around the medium risk to low risk areas. And again, if you maybe at the later stages of your life, when you're sort of looking at retirement, again, that influences the type of pathways to look at. And in this scenario, you really want the most low risk options, and you want something that can generate passive income. So we talked about like acquisitions, for example. stacking up a asset portfolio of businesses that are already profitable, again, you can live off the income. If you're married with a family, you want to be combining a combination of acquisitions with investing in the financial markets, that kind of thing. Again, these are also kind of low risk. And like we said, as a young person, you would really want to try and tap into the early stages businesses as well. So yes, life stage is important because it actually affects the kind of risk you're willing to take and what is appropriate for you to take given the stage of life you're in. Again, it really just ties in with what kind of demographic you belong to, because it also influences the kind of decisions you're making. If you are, if you're around, you between 20 to 35, there's a different way your mindset is thinking. You have different priorities, and your tolerance for risk is naturally higher. Around the middle age, again, so it's like a sliding scale. Here, you should be taking lots of risk, but as you move here, you should be looking at pathways that are more medium risk, stable type of investments. Obviously, this is just a general rule, but you can be mature and take a lot of risk. But I'm generally saying that in general, this is how our demographic affects how we think about what pathways work for us. Timeline's a very important thing in investing because the longer you leave the investment, the greater the compounding effect. I'll give you, for example, in the financial markets, we have compounding interest. So let's say the GSE, for example, the GSE on average, asset price appreciation is about 20%. So every year on average over the past 10, 15 years, the Ghana Stock Exchange is appreciating by 20% all the time. And if you put, for example, 10,000 just one time and you bought an index that tracks the GSE, 10 years with a compounded effect is like tripling your money, because Einstein said compounding interest is the eighth wonder of the world. That's something Einstein said, because it's like making money on money just by the fact that you're compounding the returns you're making. And the longer the timeline you give, the better. I like to just say in general, our wealth building strategy should always have a 10-year horizon in mindset. But as a general rule of thumb, the longer you leave the timeline, the more you benefit from things like the compounded effect. Go back. Also, another question. So yes, we should be asking ourselves, what is the timeline I'm giving myself to achieve my wealth creation objectives? But we also need to balance that with, what is the realistic timeline I need to give for my investments to provide the kind of returns that actually align with my wealth building objectives? So we can actually help you if we know what your motivating factors are, if we know what sort of amount of money you are trying to make. We can actually calculate based on returns and certain information. Okay, cool. You want to achieve financial freedom. This is the amount of capital you have. This is the life stage you're at. Realistically speaking, to reach a point where your passive income is sustaining your lifestyle, it might be that you might have to adopt a 10-year strategy. But if you're super aggressive and you want to achieve financial freedom within a 5-year period, for example, then we will also have to develop a more aggressive investment strategy for you. But fundamentally, we're balancing these two things. What's the realistic timeline I have to give for that particular pathway? But also, when do I want to achieve my motivating factors? Yes. And another thing that should influence our investment decisions is our level of competency. So we should be asking ourselves, would I class myself as a novice, an amateur, seasoned, or professional investor? If you know that you're a novice, if you know you're an amateur, then we have to look at pathways where it's suitable as an amateur and a novice. If you're more someone who's seasoned and you actually know a little bit about investing, then you can adopt the investment strategy that makes sense for that approach. No, leave it. So the next thing we're looking at is, based on my level of competency, what investment pathway should I mainly focus on? And finally, another question we want to ask ourselves is, do I want to be more of an active or a passive investor? That's another thing we should really be asking ourselves. Like, do I really want to be involved in my investments, or do I really want the most passive options available? So beyond me simply putting money in, there's very little I'm doing. These are all factors that we have to consider. Yeah. So as a whole, that is the core factors that we look at when we're thinking about understanding our unique investor profile. And like I said, what we'll be doing with everyone here is to go deeper into these things so that we can help map out the right type of pathways that actually make sense for you. So that's pretty much it on my side. We're going to have some lunch, and then we'll have the expert Q&A session. We've got the GIPC here. We've got Henry from Curo here, and a few others will be joining us. And hopefully they can answer and go deeper into some of the pathways that I've talked about. So yeah, no, thank you. And yeah.